It's your teacher price earnings ratio, and today we're going to talk about stock splits and why are they good for the company. So let me share my screen. Let's see what's going on here. Hopefully, I can see this. Um, Bring it down here. So, what is a stock split? We got a few slides here, and I'm going to be talking. I'm going to be talking simultaneously as I'm going through the slides. I'll try to make this as less as possible. This is something that you should know. Stop listening to people about you know. s- Stop listening to people that don't teach this. That's not serious about it. That's all I got to say. So, what is a stock split? It's basically a corporate action. A company takes an official action to divide its existing shares into multiple new shares. Why do they do this? Well, they have a vote on this, first of all. So they're probably going to talk about it here. So it increased shares outstanding. The total number of shares available for trading on the stock market is increased. So this first one, why do they do this? Existing shares into multiple new shares because new investors want to get in, and new investors don't want to pay 900 some dollars for for Netflix. So let's go to Netflix right quick as we're talking to this. Right now, Netflix is going to have Monday. Why am I talking about Netflix? They're going to have a 10-to-1 stock split, if I'm not mistaken, tomorrow, if I'm not mistaken. So let's go see the news on this. So this is Robinhood. I like Robinhood because it's fairly easy to use. It's just good. It's easy to use. So Netflix stock split goes live today after key amendment. So they got a 10-for-1 stock split. The move lowers the price per share. So let's just go to the slides. So right now, Netflix is how much? It already split. You know, it's $111. It was $1,000 before then. So let's is it up? So it brought the price up slightly, but not much. We'll see in the morning when the market opens. So let's go back to beautiful AI company. All right. So again, so new investors want to get in. So maintain equity value. The total market value of the company remains the same, but the price per share decreases. So the price per share decreases, so you end up getting more shares. So they decrease the price by 10, but they multiply your shares by 10. That's as simple as I can put that, without getting into outstanding shares and all that type of stuff. A stock split is a strategic move by a company to increase the number of outstanding shares, um, make the stock more affordable for individual investors, and potentially boost liquidity and investor interest. What do you mean by liquidity? More people coming in, more liquid. The more buying and selling of the stock, the easier it is for you to sell your stock and get up out of it if you want to. So timeline of stock split history. 1997, Apple conducts 2-for-1 stock split. I think that was the first stock split. So okay. 2020, Tesla announces 5-to-1. So I guess Apple was the first stock to ever split 2-for-1. They actually did another stock split, and I bought this stock in 2015. They actually did another stock split in 2020, I think also. So 2020, Tesla announces 5-to-1, 5-for-1 stock split. So that means they cut the price in half by five and multiply your shares by five. I remember this one. 2020, Nvidia announces 4-for-1 stock split. I remember this one. They just sold that stock. We're not getting into that. I had it, but it's sore subject. 2022, Amazon announces 20-for-1 stock split. This might have been the biggest stock split ever. 2014, Apple conducts 7-for-1 stock split. Yeah, that sounds about right. Man, I think I got in right after. I got in right after this. 7-for-1 stock split. 2023. Alphabet, Google. Either I was, yeah, I got in right after that. Alphabet, Google announced its 20-for-1 stock split. So there's only two companies that did a 20-for-1, if I'm not mistaken, Amazon and Alphabet, Google. So let's keep going. The more Here's a quote from Warren Buffett: the more shares there are, the more liquid the stock becomes. That's right. So lowering share price, stock splits reduce the price, the per share price, making shares more affordable for individual investors. This increased accessibility can help companies expand their investor base, potentially leading to higher trading volume and share price appreciation. More volume in the stock, the more liquid it is. It's more easy. That means when I say liquid, that means it's more easily to buy and sell this company. For instance, real estate is not liquid because you got to wait about 3 months or something like that, 3 to 6 months, or if even, or maybe even 2 months. That's operating real fast to sell your house to get your money out of it. So even if the price of the asset, the real estate went up, it still takes a long time to get your money out of it, as opposed to some of these stocks, you get your money out right away. Certain stocks they won't allow you to sell right away because it's just not that liquid. There's not a lot of buying and selling of that company. So signaling growth, signaling confidence in future growth. Companies typically conduct stock splits when their share price has significantly appreciated, signaling confidence in their future growth prospects. This indicates that the company believes its stock is undervalued and expects continued strong performance. Let's keep going. Increase investor interest. Stock splits often generate media attention and investor interest as the lower share price makes the stock more accessible to wider range of investors. This increased attention can lead to a higher trading volume and potential share price appreciation. Down here, expanding the investor base. I'm not going to read the whole thing. I just had to go through some of this stuff. By lowering the price per share, stock splits make the company's share more affordable for individual investors. Just said some of the same sentiments or information. Demonstrated financial strength. Conducting a stock split is often seen as a sign of a company's financial health and growth potential. It suggests that the company has the resources and confidence to increase the number of shares outstanding, signaling positive outlook for the future. Increased attention. Media coverage, they talk about it. Investors are interested. Trading volume is increased because the stock is cheaper, and share price appreciation. So, however many shares you got, you get more shares. Comparison pre and post split. Comparison of key financial metrics before and after a split. So, trading volume, 85% before the split, um, 92% market capitalization, 75% price earnings ratio, 90% shareholder base. So, I guess the trading volume goes up about 85%. Market capitalization goes up about 92%. Their price earnings ratio is maybe a little bit cheaper, 75% cheaper, and the shareholder base increases by 90%. And let's keep going. Stock splits can be a strategic move for companies to expand their investor base, increase liquidity, and signal confidence in their future growth. By understanding these benefits, investors can make more informed decisions and evaluate the potential impact on a company's performance. So that's pretty much it for stock splits. That's the best way that I can explain that. Stock splits. That's it. So that wasn't long at all now, was it? So, and again, that we're gonna keep more. So I gotta see, you see here, open price 1100. $43.34. This is the week high. So y'all ain't gonna see this again. I'm glad I'm covering it because I got this. I got this right here. You're not gonna see this again. You're gonna rarely see this. So, uh, excuse me. I'm sorry. So as you can see, the price is not $1,100. It is 111 dollars, and that's it for this. See you in the next slide. Peace.